Al, good to see you.
Good to see you, Peter.
Congratulations on the award that you just won.
Very exciting. It was a surprise, but after 22 years in the business, it was a welcome surprise. So thank you, and really appreciate it.
Okay, so why don't we just kick it off with a little bit of background. Tell us a little bit about what BHG, the different verticals you operate in, and why you started the company all those years ago.
Sure. Thank you. We've been in business for about 22 years. My partner Eric's out here, and another individual wanted to bring a real interesting business loan to small business owners. So we came up with an idea of a $100,000 loan that was fully funded, not at a discount, that we would move very, very quickly on, and that was pretty much unsecured, and that we would really look at the borrower and the borrower's creditworthiness to make a decision on whether or not the person would pay us back, which was obviously the most important thing. We also built a bank network on the backside. We had relationships with many community banks. And so we had an idea of originating high quality loans with business owners for, say, $100,000, small ticket, give them a term that went out at approximately 7 years, which was just a random date that we chose, 84 months. And we would fund it, and we would then sell it through our bank group, which was very small. Day one, back in 2001, it was only 5 banks at the time that were working with us. So it was a pretty simple concept. We'd originate for small businesses. We would then package it. We would underwrite it, fund it, and then sell it to a bank group on the backside that we knew. It started very, very small, $25,000 in capital, and today we're about $550 million in capital, and we started $25,000 in assets. Today we're about $4.4 billion in assets, so that's some good growth.
That's quite the story. So what verticals do you operate in today?
We operate with the consumer, and basically a very small, average size, $50,000 debt consolidation loan. We go out as far as 10 years on term. We've continued to offer our small business loan. One of the things we learned along the way was that there's a lot of entrepreneurs in the United States. And so we have a lot of different W-2 employees that have had a dream, had an idea, strong credit, strong income. And we've done a $100,000 kind of startup entrepreneurial loan for them. Has been one of our signature loans over the years too. It's a really interesting vertical.
Okay, so let's just talk about your loan marketplace for a minute. Why don't you describe it and what makes it unique?
I think we've got probably one of the most diverse marketplace funding facilities in the world. I'd go as far as saying we have 1,500 banks on any given day that come to our marketplace, come to either our live auction, our silent auction, a direct placement, a number of different ways they can buy the paper from us, and they compete for the paper. We put anywhere from 10 to 20 million a day on that auction platform. To give everybody an idea, in April and May, in each month, we had 400 unique banks buy loans during that time period. And I would consider those time periods as some of the tougher time periods I've seen in the last 20 years with what's gone on in the deposit world, as well as what's gone on with banks getting really punished, not for credit problems, but just for duration problems. So.
Right. That's great to see post SVB getting that sort of volume.
Yes.
So I want to talk about the last 12 months. There's been certainly a bit of a downturn with the consumer. There's been a lot of inflation that's been impacting the consumer. How are you adjusting your credit box, and what are you learning from your borrowers, I guess, in real time?
Great question, Peter. And I think we're learning a lot from our borrowers. I think during times like 21, backside of 20, 22, everybody pays. I think all your models work. I think you can have a model that says, I'm going to lend to just this type of person in Northern California, and this person's going to pay me back, always. And the person probably will pay you back in times like 21, 22. As we roll through 23, we're learning a lot about mistakes that we made with our model. models. So my opinion, if you can grind through a year like 23, potentially 24, and learn just a tremendous amount of information on where your models are maybe priced wrong, maybe where your credit was too aggressive, you put that into the models now, and as you come out of these years, your models are much, much more specific for performance. So we're doing a lot of data research. We're looking at why we lost, where we lost. We're adjusting different risk grades. Probably, I'd say we've lost about 18% of our volume by design for our riskier risk grades. And we're not originating that right now. We went blanket on some of our deeper risk grades, and now we've come back and said this portion is still paying very, very well, so we might add that back in.
Okay, so you are one of the very few fintech lenders that was around during the previous financial crisis. I'm talking 2008, 2009. What are some of the lessons that you took from then? Obviously, the company wasn't as big a scale as it is today, but still you were out there in the market. What was that time like, and what lessons did you learn that is helpful now?
During times like 08, 09, a little bit 23, you can't have enough margin on a deal. You stress it 2 or 3 times, and all of a sudden you realize there's certain risk grades that are stressing at 5 times. And so hopefully you have deep reserves on balance sheet. You have strong cash positions. And I think your funding sources have got to be deep and diverse, because you have to plan on losing some of those funding sources. And we've had tremendous participation over the last, throughout 23, 22, but we still have lenders who probably aren't buying from us for some reason or another. Maybe their liquidity situation, their deposit situation. So I think you have to expect that, and you have to be prepared for that. We learned through 2008. And I think we're well poised for 23. Our reserves are at record highs. Our credit is performing. We're not beyond what we thought we would stress at by any means. And I think those are some of the important things. And I think you need to stay close to your staff, very close to your key leaders. And one of the things I've never been a big proponent, and it hurts me at times it hurts me a little bit with Wall Street at times, and it hurts me with some of the bigger banks, is we grind in times like this. So we take week by week, honestly day by day, week by week, month by month, and I hate forecasting out, let's say, to 25 right now. There's just so many unknowns out there that my message to the team is do what we know, do what we do well, do it every single day, and just grind through these times and get through them is one of the biggest things I've learned from the 08, 9, 10 market.
Right, so it sounds like, as you say, banks are still lending, or they're still on your platform. But I'd be curious to know about how they have adjusted. Are you seeing, like you've said you've taken a lot of the volume of the riskiest loans off, but are banks now, the banks that may have been interested in even moderate risk, are they adjusting their credit box to say, you know what, we are only taking prime consumers right now?
They have, and one of the again, the positive things about times like this is that the competition tends to go to the sidelines for various reasons, and we don't. We're on track to originate to $370 million this month, yet our lead flow is at record highs. We're seeing 70,000 leads a month right now through our digital marketing and our other marketing channels, our direct mail. So our selection process is enabled to really take the best of the best. We did probably $430 million, I think it was in October of 22. So we're at 370 right now, and you're $50 million less, and you're seeing more lead flow than we've ever seen in the history of the company. And what that equates is you get to go in and select some very, very strong credits. We're passing those credits along to the banks. The banks, 100%, Peter, are looking for stronger credits. They're looking for stuff that they feel is going to get them home, and we're able to deliver that right now, given the lead flow, given what we're funding, and given that our FICO scores, our score, which is internal, have never been higher. They're at record highs with the fundings we're doing. So we're able to meet that desire to do a stronger credit at the bank level. And the other thing I'll say is, one thing the banks are demanding, they're demanding more rate. You know, they're following Fed funds like everybody else. So as Fed funds have gone up 500 basis points, we've had to adjust. You know, we did an ABS for $500 million at a 167 in early or late 21. I told everybody, you'll never see a rate like this again. We should take $2 billion if we can to the market. And we went to market literally the week of the SVB failure, and we were at 750. So, you know, Wall Street's repriced, the banks have repriced, and we've had to reprice on the front end too.
But you got that deal done, right?
We got the deal done. We priced it. SVB was taken over on Friday, and we priced the following Friday. So it was a turbulent market, but it was about $280 million approximately that we sold in that period, which I was happy to be able to do.
Right, yeah, for sure. That's that is actually impressive. And so, what? Maybe we can talk a little bit about how you kind of have built your credit team, because I'm sure in the audience there's a lot of people working in credit teams. Would love to get sort of some insight into how a company like BHG, you know, how you've created and how you run the credit team.
It's a great question, Peter, and it's interesting because it ebbs and flows. We have 90 underwriters on staffs. Some have been with us for over 15 years. We have 50 data engineers who drive the credit team. So the credit team isn't, I would say, making decisions on their own per se. They're really driven by the data, and they're driven by the data engineers who are tweaking the models, as we talked about a little bit ago, every day. But if you talked to me 2 years ago, we were really driving towards trying to have no friction and just be technology all the way through. Today, again, you ebb and flow. We're ebbing a little bit where, you know, there's a lot of stacking that's come at fintechs. You know, we're targeted by borrowers who have no intention of paying. And so we've added a 30-member fraud team in the last 3 years, which is, I think, second to none. And we really have to look at what can we do to prevent that from happening to us. And there's some manual processes in the underwriting scenario that you can do that I think slows that down tremendously, requiring bank statements. Looking further into the credit than just a flow pass-through scoring model that we might have been really interested in, you know, when you go back 2 years ago. So right now, we run heavily on technology, but we also use credit officers, especially in that area where the applicant looks like it may be a little bit interesting, and we may want to do a little bit more digging to make sure that it is somebody that's not going to look to just use us for a stacking opportunity.
Right, interesting. So can we put the Slido QR code on the screen so people can ask questions? There we go. Thank you very much. If you have a question for Al, you can scan that code and it will take you into a place to ask questions. So then maybe we can talk, I just want to dive in a little bit more, if we could, about you said that you've got record borrowers coming to your platform today. So demand is there. Is that across the board for the demand that you're getting? Is it, and what are these borrowers looking to do for the most part?
It's a record demand. It is across the board, which is great news. I mean, we're seeing probably the best credits we've ever seen in the history of the company, and I'm guarantee you we're seeing volume of the worst credits that we've ever seen. So it's heavily across the board, and as I said, the good news is we're seeing some, you know, super credits. I think very much what they've always looked, consolidate debt, your small businesses maybe looking to take down a little extra capital as the environment gets a little scarier when you turn on CNBC and you see the regional banks last week get hit, and then you see them come back, which was awesome. You know, I think the CPI figure today was encouraging, down for yet another month. Fed looking like they're pausing here for 5 or 6 months would be super. But I still think the consumer's seeing all that too, and they're just looking to take a little bit of safety capital for themselves, make sure they have a little backup to cover their debt. The business owners want a little bit in the coffee jar to basically have for down the road in case it gets a little dicier. So we're hearing that a lot as people are coming in because, and again, we have people that are looking to extend their term. Maybe their payment's a little bit tough on an adjustable they had or other debt that they had. We go out 12 years, so it's a very, very affordable payment out at the 12-year mark. And our prepayment penalties are pretty minimal, so they can go out there, they can borrow the money. The rate may be a little bit higher than what they're hoping for, but again, in times like this, they have the ability to pay it off if things don't get as bleak as some of the different announcers make it look.
Right. So let's just get to one of the audience questions here. How do you prevent loan stacking, and what are some of the signals that you track for manual underwriting?
Great question. One of the things the analysts have come up with is if you're not in our universe of, let's say, purchase data on borrowers and you come in digitally, your risk jumps 3 to 4 or 5 times. Crazy. So needless to say, we're cross-referencing anybody that comes in digitally to see if they're in our universe of what we've purchased with specific credit desires in mind when we're looking to market them. In that situation, we would look for additional information. We would look for potential checking account information. We would have a live underwriter on with them, and we would be probably digging much deeper into what their current situation looks like, and also looking to get a snapshot of their, let's say, last 12 months use of money. How much do you have coming in? How much do you have going out? Does it look like you're just supporting a higher FICO when really all you're planning to do is borrow as much as you can from every fintech and then just dump? And so those are some of the processes we would use to identify that type of borrower.
Right. Okay, maybe we'll just take one more question here. So any pieces of data your underwriting team uses that you would consider unique?
Probably.
Not, you don't want to share, do you?
Probably a much better question for one, Carlos Ortigos, who's our Chief Revenue Officer and runs our data engineers. They're looking at, we look at a lot of traditional data, and I think we just score it and weight it a little bit differently. And like I said to start the session off, not always accurately. You find out in times like this that, geez, we scored this, we thought this was dependable, and it's really not performing like we thought it was going to. So we may want to weight that differently in the future when we're enduring what we're enduring in 23. Right.
Okay, so last question then. You've touched on it, but I'd love to kind of get you to tackle it directly. What is the key for a lender to survive during turbulent times like we have now?
I think cash is king. I think you have to have, I think reserves are very important. We're at the highest percentage reserve we've ever been at. We honestly, historically, over the last 6 months have been reserving at about 135% of our 12-month trailing loss. So we're well above our methodology going into this. Again, I just don't think you can have enough in reserves when you're in turbulent times like this. And I think what we've talked about, key funding sources. You want to have we've got a tremendous operating line. It's about $850 million led by BMO. We have relationships with big PEs. we do go to the ABS, and then we have our bank network of 1,555 banks that we sell to every day. You will have ebb and flows with those sources, those varying sources, but somebody, thank God, has always been there for us. Right. And so I think it's important to have those diverse funding sources in times like this.
Yeah, that is good advice. Well, Al Crawford, CEO of BHG, thank you so much for joining us here today. Give him a hand.
Thank you, Peter. Appreciate it.